The global debt problem has emerged as one of the most complicated and far-reaching challenges of our time. It is profoundly entwined with the fabric of modern economies and one of the most significant challenges of our day. Given that the total amount of global debt has surpassed $300 trillion, which is an amount that is approximately 4 times the size of the world's gross domestic product, the magnitude of the problem raises significant concerns regarding the stability of the financial system. The ever-increasing burden impacts not just sovereign nations, but also households and multinational enterprises, resulting in the formation of a complex web of responsibilities that serves as the foundation for economic activity while simultaneously posing a threat to its stability. As people all across the world struggle to come to terms with the ramifications of such huge debt, the possibility of an economic collapse looms. Historically speaking, debt has been an essential driving force for economic expansion. Governments take out loans in order to finance social programs, education, healthcare, and infrastructure in an effort to encourage economic growth and enhance the quality of life for their citizens. When it comes to expanding their operations, innovating, and creating new jobs, corporations take on debt. On the other hand, individuals rely on credit for everything from purchasing a home to obtaining an education. The reliance on debt, on the other hand, has become more out of control over the course of the last few decades. Policies that maintained interest rates at historically low levels, notably in the years following the financial crisis of 2008, promoted borrowing on a scale that had never been seen before. These policies, which were intended to revitalize economies that were struggling, also contributed to the creation of an atmosphere in which the buildup of debt exceeded the growth that was necessary to maintain it. An additional obstacle appeared at the same time that the global economy started its uneven recovery: inflation. Central banks were compelled to take action as a result of rising prices, which were caused by disruptions in supply chains, increasing demand, and geopolitical concerns such as the conflict between Russia and Ukraine. In an effort to keep inflation under control, the Federal Reserve of the United States and other central banks hiked interest rates, which resulted in a large increase in the cost of borrowing money. Higher interest rates added an additional layer of stress to the situation for governments, corporations, and people that were already deeply indebted. There are fewer resources available for important services such as healthcare, education, and infrastructure investment as a result of the ever-increasing proportion of national budgets that are being allocated to the financing of sovereign debt. As their currencies decline against the dollar, emerging nations, many of which hold large debt denominated in foreign currencies, suffer compounding difficulties. This is because the cost of debt service becomes even more expensive. The interconnection of the global financial system incorporates an additional element of complexity into the equation. The instability of economies that are located distant from the epicenter of the crisis can be caused by sovereign debt crises that happen in one region and swiftly spread to other regions and marketplaces throughout the world. Due to the fact that losses in one area can damage confidence in the market as a whole, financial institutions that hold major percentages of sovereign debt are particularly vulnerable. The dynamics of this phenomenon were brought into sharp relief during the global financial crisis of 2008, when localized problems in the housing market in the United States snowballed into a global financial collapse. There are risks that are comparable to those that exist today, but they are on a far greater scale. The sheer amount of global debt magnifies the potential for systemic shocks. The debt crisis has a tremendous impact on the lives of people. Austerity measures, which involve lowering spending on social services and infrastructure, are frequently implemented by governments as they struggle to manage the pressures of their high levels of debt. As a result of these reductions, the most vulnerable communities are disproportionately affected, which further exacerbates inequality and fuels social unrest. There is a risk that the crisis will impede progress toward achieving development and poverty alleviation goals in nations with low incomes. Long-term prosperity and stability are being undermined by the fact that many countries are now devoting more resources to the payment of their debt than they do to education or healthcare. At the same time as citizens are pushing back against policies that privilege creditors over public well-being, social upheavals that are tied to economic stress are becoming increasingly widespread. It will be a challenging endeavor to find answers to the dilemma of the global debt crisis. Given the competing interests of states and financial organizations, international cooperation is not only necessary, but also frequently challenging to achieve through its implementation. There have been suggestions made regarding the possibility of reducing the load by reorganizing or forgiving the debt of the most impoverished nations. However, such initiatives are met with opposition by creditors and need a large amount of political will. A number of specialists argue for changes to be made to the global financial system. One of these changes would be the establishment of procedures that would link the repayment of debt to economic performance. This would make it possible for nations to adjust their responsibilities during times of economic insecurity. Others call for more active policies to address systemic inequalities and foster sustainable economic growth, with the goal of reducing reliance on development that is powered by debt. The planet is currently at a pivotal juncture. The decisions that are made in an attempt to handle the debt crisis will have far-reaching effects, and they will shape the economic and social landscapes for years to come. When prompt action is not taken, not only is there a risk of financial instability, but there is also a risk of a wider erosion of trust in institutions and governments. Whether or not the international community is capable of rising to the occasion and discovering long-term answers to a problem of this magnitude is still a question that needs to be answered. The stakes are tremendous, and the repercussions of inaction could end up redefining the course that the 21st century will follow. Would you like it? Hit the like button and subscribe to our channels for more interesting and informative videos.